Namaskar, good morning. We had discussed in the last counseling session certain methods of procuring finance, specifically equity shares, preference shares, debentures, bonds, SPN. Now, continuing that, the next method of procuring finance is public deposits. According to the Companies Act 2013, all types of money received by a company, except the contribution to capital, would fall in the category of deposits. Fixed deposits, which are also known as public deposits, have become attractive for companies as well as investors. For the companies, public deposits are easy form of fund mobilization without mortgaging assets. For the investors, public deposits provide a simple avenue for investment in good and popular companies at a better rate of interest without many formalities as involved in the case of shares and debentures. The next source of finance is bank credit. Banks, including the development finance institutions, have become chief source of funds to the corporate sector. In other words, the industrial credit is a major revenue earner to the banking sector, as other types of credit like agricultural credit are subject to many restrictive conditions and regulations of Reserve Bank of India, and therefore the margins on such credits are very thin. Banks extend credit to industries and commercial establishments at varying rate of interest depending upon the credit worthiness of the borrower as well as period of loan. Venture capital. Governments around the world have been actively encouraging small and medium businesses, especially feasible projects. The usual sources of capital generally do not suit those promoters who are not in a position to put in enough contribution to satisfy the other investors and lending institutions. Even if other investors are willing to chip in despite negligible promoter contributions, the promoter cannot retain the control of the business after establishing and stabilizing in a profitable path, if the other investors choose to vote them out. Now, financing through global capital markets. Major segments of international financial markets from where the domestic corporate can raise funds are the foreign bond market, The foreign bond market is that portion of the domestic bond market which represents issues floated by the foreign companies or governments. In context of India, the bond issues floated by USA or Germany or any other foreign corporate or government and subscribed by residents or corporate of these countries will represent the foreign bond market for them. The main advantage of using foreign bond market is increase in reputation due to close scrutiny by institutional investors, diversifying and broadening of risk and lower cost of funds. The foreign bond instruments are primarily of three types: fixed rate issues, just like debentures; floating rate issues, just like coupon bonds; and equity-related issues, just like equity shares. In fixed rate issues, the interest rate for the whole tenure of the issue. Maturity date is fixed, and principal amount is paid in full at time of maturity. Floating rate bonds have variable interest rate during the tenure of the bond, and the interest rate is reset at fixed interval. The equity-related bonds combine features of both bond and equity and are of principally of two types. Convertible bonds are fixed rate bonds that are convertible into equity in pre-decided rate before maturity. Equity bonds provides the holders the right to buy a specified number of shares at a specified price during a designated time period. The foreign equity market. When companies decide to raise equity capital from diversified investors, the natural choice is cross-listing of share of the company over various stock exchanges located in different countries, either through IPOs, initial public offerings, or through seasoned equity offerings. Foreign listing allows companies to diversify equity funding risk. Sometimes the equity offerings are large enough that a single domestic market may not meet the entire funding requirement. Foreign offering can also increase the potential demand for the company's share and hence the price. Project finance. Large scale capital intensive, long term capital investments are usually financed through project finance. Project finance is a non-recourse lending secured by project and potential cash flows associated with the project. The distinguished feature of project finance is the ownership structure of the project, which is owned by single purpose corporation, also known as special purpose vehicle, SPV. This SPV is legally independent of its sponsors. Project finance is defined as the raising of funds to finance an economically separable capital investment project in which the providers of the funds look primarily to the cash flow from the project as the source of funds to service their loans and provide the return of and a return on their equity investment in the project. The euro currency market. The euro currency market is outside the legal purview of the country in whose currency the finances are raised. The term euro is affixed to an offshore currency transaction. Capital raised in the euro currency market can be classified temporarily as under euro loans. Euro loans are essentially short term accommodations provided by bankers to their clients. The interest charge is a markup on the London interbank offered rate, LIBOR, which varies according to the credit worthiness of the borrowing company. Euro commercial papers are short-term promissory euro currency notes, and these notes are bearer, means may be paid to any person who holds them. These are typically issued at a discount of their face value, which represent the yield to the investors. Syndicated euro currency loans are given by the syndicates of banks to borrowers at a variable rate of interest. For example, LIBOR plus 0.25%. Revolving underwriting facility, RUF, involves sale of bearer notes to investors on a revolving basis. The investors under RUF undertake to make certain amounts of funds available to the borrower up to a certain date during which the borrower is free to draw down, repay, and redraw the funds after giving due notice. Euro bonds are long-term unsecured debt securities, usually fixed rate instruments with bullet repayments. These are targeted at high net worth individuals and institutions and are listed on stock exchange such as Luxembourg or London to provide liquidity. Euro equities are company shares which could either be directly offered listing on the foreign stock exchanges or take the form of global depository receipts, which shares underlying such receipts. Now, other modes of financing. Long-term finance is raised when the need for funds is for more than 1 year. Typically, long-term finance is required for acquisition of fixed assets, having a life more than 1 year, or investment which have long-term impact on the earnings of the company. For instance, if a firm wants to buy a patent or brand, which in turn contributes to the sales of the firm for a long term, it requires long-term funds for such acquisition. Leasing and hire purchase. Firms need finance to acquire assets. Instead of borrowing and acquiring assets, it is possible for firms to acquire the assets on lease. There are two types of leasing: operational lease and financial lease. Operational lease is used when the assets are used for temporary period and the asset is returned at the end of the short period. While operational lease is not considered a source of finance, financial lease is used when the assets are required permanently or for a long period. Normally, the assets are ultimately purchased by the firm from the lessor at a nominal value. During the period of lease, the firm which acquired the assets on lease means lessee can use the assets, but it is not the owner of the assets. The ownership rests with the company which provided the assets on lease. During the period of lease, the lessee has to pay lease rent to the lessor. Lessee is not entitled for any depreciation, whereas lessor can claim depreciation for the assets for tax purposes. Hire purchase is similar to financial lease. A hire purchase transaction is usually defined as one where the hirer has at the end of the fixed term of hire an option to buy the assets at a token value. The word hire purchase has got two words, hire and purchase. During the agreement time period, it continues to be hire, means the purchaser is paying the hire charges. But in the end, this hire is converted in the form of purchase and the purchaser becomes the owner of the assets. In other words, financial leases with an option to buy the assets at the end of the lease term can be called a hire purchase transaction. Supplier's credit. The concept of supplier credit is fairly simple and in existence for a long time. Under this, the equipment suppliers provide long-term credit and accept the payment for the supply of equipment over a longer period of time, say 5 to 8 years. In that process, the company which acquires the assets neither take bank loan nor approach leasing company for credit, but directly takes the credit from the supplier of the equipment. In other words, the supplier of equipment acts as a lender or lessor. Assets securitization. Securitization is fairly a simple concept. It is the process through which an asset may be fixed or may be current is converted into financial claim. In other words, it brings liquidity to an illiquid asset. The concept is very popular in housing finance. Let us explain the concept with a simple example. Suppose a housing finance company has rupees 100 crore. During the first 6 months, it accepts the loan proposal and lent rupees 100 crore at an average interest rate of 10% and the duration of the loan is 15 years. Suppose the housing finance company gets some more loan application, say for rupees 20 crore in 7th month. The company has to look for new source of finance to fund the new loan proposals. Since it has already invested the entire capital and converted them into illiquid long-term 15 years receivables. The growth of the housing finance company is thus restricted to its ability to raise additional funds. Securitization assumes importance in this context. Suppose a group of pension companies is willing to buy rupees 100 crore 15 years receivable from the housing finance company, discounting the receivables at say 9%. With this new cash flow, the housing finance company can finance new loans without making any fresh borrowing. In other words, the housing finance company has sold its 15-year illiquid receivables and raised money market against it. The process of selling makes the concept slightly different from simple bill discounting concept. Under securitization, an intermediary agency is created, which initially buys the illiquid assets and against that it issues securities, which are tradable in the market through listing. Thus, it is also called asset backed securities or mortgage backed securities. The value of the securities is improved by taking credit rating and often through insurance cover. Now, venture capital. While leasing or hire purchase or hire finance, supplies credit or securitization are debt financing. Venture capital is a equity finance. Venture capital is an investment in early stage, high growth projects, which are high risk with the potential to give extraordinarily high returns over a period ranging from 3 to 7 years. The risk factor being high, the probability of failure is also high. The returns to the venture capitalists are from the handful of projects which succeed. Non-traditional sources of short-term finance. As in the case of long-term finance, firms can raise short-term finance from banks and other investors. However, in recent time, new methods of financing are also being used to raise funds for working capital. These methods are the first one, commercial paper, CP. Companies with good credit rating can raise money directly from the market for working capital purposes by issuing commercial papers. Commercial papers are unsecured notes but negotiable and hence liquid. Why firms issue commercial paper and other invest in commercial paper? As discussed earlier, loan typically binds both lender and borrower for a period. The option for exit is difficult to exercise, whereas instruments like commercial papers enable both lenders and borrowers to move out of the relationship in a short period of time. Since lender and borrower meet directly, the cost of commercial paper borrowing will be lesser than working capital loan. Many banks and cash-rich companies participate in commercial papers, which are issued by high-quality companies. Since they are liquid, even banks are willing to invest money in commercial papers. Factoring service. Factoring is essentially a management service. Rather, you may say financial management service designed to help firms better manage their receivables. It is, in fact, a way of offloading a firm's receivables and credit management onto someone else. In this case, the factoring agency or the factor. Factoring involves an outright sale of the receivables of a firm by another firm, specializing in the management of trade credit, called the factor. Under a typical factoring arrangement, a factor collects the accounts on the due dates, effects payments to its client firm on these days, irrespective of whether or not it has received payment or not, and also assumes the credit risk associated with the collection of the accounts. For rendering these services, the factor charges a fee, which is usually expressed as a percentage of the total value of the receivables factor. Factoring is thus an alternative to in-house management of receivables. Now, strategic financing decisions. First of all, capital restructuring. To meet competitive challenges from the foray of multinationals following liberalization, privatization, and globalization, and to ensure their survival, Indian corporate giants such as Tata, Aditya Builders, Reliance, Hindustan Unilever, SBI, Adani Group, LIC have of late pursued the strategy of restructuring their assets, products, technologies, market and manpower, resulting in a spate of mergers and acquisition in recent years. Corporate restructuring, the concept. Corporate restructuring is a process of redefining the basic line of business and discovering a common thread for the firm's existence and consolidation. Thus, restructuring is a process by which a corporate enterprise seeks to alter what it owes, refocus itself to specific task performance. This it does after making a detailed analysis of itself at a point of time. At times, restructuring would radically alter a firm's product market mix, capital structure, asset mix, and organization so as to enhance the value of the firm and attain competitive edge on sustainable basis. While planning for restructuring, The management should specify what type of business the firm can do most effectively. Those business market areas which offer little or no potential should be removed from the basic business structure. Others having unsatisfactory earnings, poor competitive position, or management incapability should also be discontinued. Motives for restructuring. Corporate enterprises are motivated to restructure themselves in view of the following forces. Number one, the government policy of liberalization, privatization, and globalization spurred many Indian organizations to restructure their product mix, market, technologies, etc., so as to meet the competitive challenges in terms of cost, quality, and delivery. Many organizations pursued the strategy of accessing new market and customer segment. Convertibility of rupee has encouraged many medium-sized companies to operate in the global market. Revolution in information technology facilitated companies to adopt new changes in the field of communication for improving corporate performance. Wrong diversification and divisionalization strategy has led many organizations to revamp themselves. New business embraced by companies in the past had to be dropped because of their irrelevance in the changed environment. Product divisions which do not fit into companies' care business are being divested. Improved productivity and cost reduction have necessitated downsizing of the workforce. Another possible reason for restructuring is improved management. Some companies are suffering because of inefficient management. Such companies opted for change in top management. At times, organizations are motivated to reorganize their financial structure for improving the financial strength and improving operating performance. Dimension of restructuring. Corporate restructuring is a broad umbrella that covers the following. Financial restructuring. Number one, this involves decisions pertaining to acquisition of a new business or acquisition of another competitive company's business, mergers of two companies, divestitures means selling some business or part of business, leveraged buyout, leverage recapitalization, and reorganization of capital, etc. The second one is technological restructuring. This involves decisions pertaining to redesigning the business process through revamping existing technologies. Third one is market restructuring. This involves decisions regarding product market positioning to suit the changed situations. Fourth is organizational restructuring. During the post liberalization period, many Indian firms embarked on organizational restructuring program through regrouping the existing businesses into a few compact business units, decentralization, and delaying. Delayering, downsizing, outsourcing, non-value adding activities, and subcontracting. Now, the most important is financial restructuring. Concept of financial restructuring. Financial restructuring is the process of reorganizing the company by effecting major changes in ownership pattern, asset mix, operations that are outside the ordinary course of business. Thus, financial restructuring covers many things such as the mergers and takeovers, divestitures, leverage recapitalization, spin-offs, carve-outs, reorganization of capital and financial reconstructions. The first one, mergers and takeover concept. A company intending to acquire another company may buy the assets or stock or may combine with the latter. Thus, acquisition of an organization is accomplished either through the process of merger or through the takeover route. Merger is combination of two or more companies into a single company where one survives and the other lose their identity or a new company is formed. Divestitures. Divestiture as form of corporate restructuring signifies the transfer of ownership of a unit, division, or a plant to someone else. Sale of its cement division by Coromandel Fertilizers Limited to India Cement Limited is an example of divestiture. Divestiture strategy is pursued generally by highly diversified firms who have had difficulty in managing broad diversification and have elected to divest certain of their businesses to focus their total attention and resources on a lesser number of core businesses. Divesting such businesses frees resources that can be used to reduce debt, to support expansion of the remaining business, or to make acquisitions that materially strengthen the company's competitive position in one or more of the remaining core business. Leveraged buyout, LBO. It is an important form of financial restructuring which represents transfer of an ownership consummated heavily with debt. Leverage buyout involves an acquisition of a division of a company or sometimes other subunit. At times, it entails the acquisition of an entire company. Leveraged recapitalization. Another kind of financial restructuring is leverage recapitalization, LR. LR is a process of raising funds through increased leverage and using the cash so raised to distribute to equity owners, often by means of dividend. In this transaction, management and other insiders do not participate in the payout but take additional shares instead. As a result, their proportional ownership of the company increases sharply. Reorganization of capital. Reorganization of capital refers to the restructuring of company by affecting change in the capital structure of the company with a view to improving its financial strength. It is an adjustment of gearing, that is debt equity ratio of the company, so as to maximize the wealth of the shareholders. Financial reconstruction. Financial reconstruction is the recasting of firm's capital structure to reduce the amount of fixed burden of leverage. Where firm has been suffering operating losses for several years, but has potential to recover in future, and its economic worth as an operating entity is greater than its liquidation value, management may think of keeping the firm alive by changing its capital structure. The major difference between reorganization of capital and financial reconstruction is that the former is resorted to for further improving financial health of the firm, but the latter is taken up when the firm is continuously suffering losses and is heading towards liquidation. Now, financial engineering. Before we discuss financial engineering, let us discuss the broad classification of assets classes, which are classified in 6 groups: fixed income, credit, emerging markets, equities, commodities, and foreign exchange. Each of these assets classes have their own risk and return profile, and combination of return profile of different classes into a new product is termed as financial engineering and is primarily used for reallocation, yield reduction, means lower effective interest rate, enhanced liquidity, reduction in information asymmetry, thereby by reducing agency cost, reduction in transaction cost, and playing on tax arbitrage. Factors contributing to financial engineering. Tax advantage. Everybody wants to reduce his tax liabilities, or the best one, there should be no tax liability. For that purpose, financial engineering is done. Reduce transaction cost. Reduced agency cost. Risk reallocation increases liquidity. Regulatory or legislative factors, level and volatility of interest rates, level and volatility of prices, academic work, accounting benefits, technological developments, and other factors. Financial engineering process. Financial engineering process is no different from the process that any firm follows in developing new value added products or services. The process starts with identification or realization of some needs. Sometimes such needs are known, but many times you have to identify the needs of the market and bring out products or services or solution to the users without expecting them to formally communicate such needs. Like car manufacturers, mutual fund managers have to constantly look for ways to innovate new products that are appealing to investors and at the same time achieve certain additional objectives. It is quite possible that you may add one more feature to the existing products, which increase its value to the users. Once the need is identified, an initial sketch of the product is developed. At this stage, depending on the product requirement, complex model building exercise is used. The next stage is testing of the product. So check whether the desired result is achieved. Financial engineering in fixed income securities. Instead of fixing the float to bank rate or LIBOR, if the issuer and investor fix the float to some other value, they can tackle different types of risk. For instance, a commodity producer or oil company is exposed to considerable amount of commodity or oil price risk. Prices of commodities, oil, metal, etc. are highly volatile, and producers of these products are exposed to high level of risk. In other words, in a balance sheet context, the asset side risk, also called business or operating risk, is very high. Naturally, for these companies, a pure fixed interest rate paying debt will add more problems. For some regions, if the prices of products crash, it may hurt the business considerably. While debt creates such adverse effects in a falling prices, it creates value when price moves upward. The issue before the finance managers of these companies is how to resolve the negative effect of the debt in a falling market price while retaining profit opportunity. When the prices move up, it is resolved by linking floating rate with the commonly commodity price index. That is, the investors will get higher interest rate when the market price of the commodity moves up and gets lower return when the prices fall. For instance, if the interest rate of such floating bond is 4% plus changes in oil price or price index, the bondholders will get a return of 4% only if the price remains same. But if the price increases by 3%, then bondholder will get 4% plus 3% or 7%. Normally, there will be a floor rate and cap rate for such issues. In the above case, if the floor rate is 4% and cap is 10%, the interest rate will be minimum of 4%, even if oil prices declines by 10%. And it will be the maximum 10% even when the oil prices increases by 20%. So the instrument by and large retains the characteristics of debt, but it brings some equity flavor into the instrument. Financial engineering in equity products. A more common form of equity shares is differential voting rights. Shares in which all classes of shares have voting rights, but in a disproportionate form. For instance, Class A shares will have voting right of one vote for one share, whereas Class B shares will have a voting right of 100 votes for one share. Sometimes the arrangement will be such that Class B shareholder will not get any dividend from the company or get only a meager, say 1/10 of the dividend of Class A shareholder. Typically, promoters would subscribe Class B shares, whereas most small investors would prefer Class A shares. Initially, companies will issue Class A shares to all investors and subsequently will announce for exchanging Class A shares with Class B share on certain terms. For example, for every 10 shares of Class A surrendered, the shareholder will get one Class B share which has 100 voting rights per share and no dividend. Naturally, those who are interested in control stake would go for exchange. But those who are interested only the investment, they will prefer to remain in Class A. Financial engineering in derivatives. Future is a standardized forward contract entered between two parties and traded in the exchange. Because of standardization, it is possible to trade in organized exchanges, and because it is traded in exchanges, it is easy to get in and get out of the contract. Today, futures are highly liquid and available on large number of financial products like stocks, bonds, currencies, and commodities like coffee, cotton, plantation, etc. They are also available on metals and energy products. While futures resolve basic problem of liquidity, while allowing parties to lock in the price today so that there is no price risk, the parties forego the opportunity to exploit the price advantage. For instance, the buyer will continue to pay a higher price even the current market price is much lower. Of course, the producers gain in such situation. On the other hand, if the prices move up, the producer continue to sell at lower price while buyers gain in such a situation. Hence, when the prices move up or down, one of the parties gain and other incur loss. Financial engineers designed options contract which allows buyer of the option to retain in the benefit of price movement while avoiding loss. Consumer buy call option which give them a right to buy at a predetermined price. They exercise the right only when the price is more than the predetermined price. Producers buy put option which give them a right to sell at a predetermined price, and producers exercise their right when the price moves downward. Option contracts split the risk into positive and negative and allow parties to take whatever they like. Buyers of option who take positive side of the risk are expected to pay a price of premium to seller of option who take negative side of the risk. Now the last part, investor relations. Basically, the demand for corporate information comes from the shareholders and investors, managers, employees, customers, lenders, and other suppliers, security analysts, policy makers, regulators, and the government. Purpose of soliciting information by different stakeholders of the organization varies to a great extent. For instance, the government seeks financial information of the company mainly to check if it pays the right amount of taxes, as also to check if it does not violate licenses granted, exempt policies, etc. Basically, the investor demands can be classified into three basic categories: transparency and disclosure, good corporate governance, investor service. Transparency and disclosure. Companies typically do not make available information on a day to day basis because of strategic reasons and huge costs involved in collection and dissemination of such information to all the users. At the same time, the companies disclose summary of information periodically for various purposes. Corporate disclosure of information is determined by the market forces, cost associated with corporate disclosures, and the regulatory forces. There has been tremendous improvement in the last few years in the disclosure level of the Indian companies. This is mainly due to new accounting standards introduced by ICAI, like consolidation of accounts, segment reporting, revealing the related party transaction, revealing the intangible asset valuation, etc. Apart from this, the listing requirement had also been tightened, and listing requirements demanded more information from the companies. One such latest requirement is the introduction of Clause 49 on corporate governance code. Accordingly, every company wanting to get listed in the stock exchange will have to disclose the corporate governance system and procedures existing within the company. Detailed aspect discussion on this mode has been in the next section. Corporate governance plays an important role in building a good relationship with the investors. This is because when the companies are able to keep their investor well informed about the way the business is done in a transparent manner, they should definitely present a positive image. No investor would want to do away with his investment from a such circumstance. However, the existence of corporate governance by itself does not become a sufficient condition for the better performance of a firm. It can, however, become a necessary condition in the highly competitive world, particularly when the market has become global. But why does it become a necessary condition? Corporate governance can do a lot of things for the better performance of the company. Good corporate governance helps the company to evaluate the better investment decisions. It would help resolve the agency cost of debt and equity. It can help retain the existing investors. It can attract more and more investors, implying raising capital would be easier. Suppliers would be willing to deal with such companies. Lenders should not be hesitating to lend to such companies as the system are transport and the performance of the company is well revealed. We had seen companies gain a substantial advantage by transparent policies and disclosure practices. However, in order to sustain the good relationship and the companies need to provide the right information at the right time at the right place. Further, they must also attend to the queries of the investors promptly and provide them a better service. That's all. Namaskar.